So, you're thinking about diving into real estate investing? Smart move. Real estate has long been one of the most reliable ways to build wealth. It's tangible, it appreciates over time, and if done right, it can generate passive income while you sleep. But let's be real, it's not a get-rich-quick scheme. It takes planning, knowledge, and a bit of grit. This video is your roadmap. Whether you're starting with zero experience or just want to sharpen your strategy, we'll walk through the entire process step by step. And don't worry, we'll break down all the jargon so you won't feel like you're drowning in real estate lingo. What is real estate investing? Real estate investing means purchasing property to earn a return, either through rental income, resale profits, or both. You're not just buying a home to live in, you're buying an asset that works for you. Types of real estate investments: residential properties, single-family homes, duplexes, condos, apartments. Commercial properties: office buildings, retail spaces, warehouses. Industrial properties, factories, distribution centers. Raw land: undeveloped land you can build on or hold for appreciation. REITs, real estate investment trusts, stocks that let you invest in real estate without owning physical property. Step-by-step process to start investing. Step 1. Educate yourself. Before you spend a dime, spend time learning. Read books, listen to podcasts, watch YouTube channels like the one you're about to create, and follow experienced investors. Recommended reads: Rich Dad, Poor Dad by Robert Kiyosaki, The Millionaire Real Estate Investor by Gary Keller. Step 2. Set your investment goals. Ask yourself, do I want cash flow or long-term appreciation? Am I investing for retirement, financial freedom, or extra income? How hands-on do I want to be? Your goals will shape your strategy. Step 3. Assess your finances. You don't need to be rich to start, but you do need a plan. Check your credit score. Save for a down payment, usually 10-20%. Get pre-approved for a mortgage. Budget for repairs, vacancies, and unexpected costs. Step 4. Choose your investment strategy. There are several ways to approach real estate investing, and the strategy you choose should align with your goals, risk tolerance, and how involved you want to be. 1. Buy and hold. This is one of the most popular strategies. You purchase a property and rent it out long-term, earning consistent monthly income while the property appreciates over time. It's moderately risky and requires a medium level of involvement, especially if you manage the property yourself. 2. Fix and flip. You buy a property that needs work, renovate it, and sell it for a profit. This strategy can be highly profitable, but also comes with high risk. It demands a lot of hands-on effort, from managing contractors to timing the market correctly. 3. Buy, rehab, rent, refinance, repeat. This method is a hybrid of buy and hold and fix and flip. You buy a distressed property, fix it up, rent it out, refinance to pull out equity, and then use that equity to buy another property. It's a high-risk, high-reward strategy that requires significant involvement and financial planning. 4. House hacking. This is a great entry-level strategy. You buy a multi-unit property, live in one unit, and rent out the others. Your tenants help pay the mortgage, and you build equity while living cheaply. It's low risk and moderately hands-on. 5. Wholesaling. You find undervalued properties, get them under contract, and sell the contract to another investor for a fee. You don't need much capital to start, but it requires hustle and strong networking skills. It's low risk financially, but very high in terms of effort and time. Step 5. Pick a market. Not all locations are created equal. Look for job growth, population growth, low crime rates, good schools, affordable property prices. Use tools like Zillow, Redfin, and local government data to research. Step 6. Build your team. You'll need real estate agent, mortgage broker, property manager, contractor, accountant, lawyer. Don't go solo. Real estate is a team sport. Step 7. Find a property. Use online platforms, auctions, or local listings. Analyze each deal carefully. What's the purchase price? What are the expected rents? What are the expenses? What's the ROI? Step 8. Run the numbers. Use the 1% rule. Monthly rent should be at least 1% of the purchase price. Example: If a house costs $150,000, it should rent for at least $1, $500 month. Also calculate cash flow, cap rate, ROI, break-even point. Step 9, secure financing. Options include conventional mortgage, FHA loans, hard money lenders, private lenders, seller financing. Choose what fits your budget and timeline. Step 10, close the deal. Once your offer is accepted, get an inspection. Finalize financing. Sign the paperwork. Celebrate, but don't overspend on champagne. Step 11, manage the property. Decide if you'll DIY or hire a property manager. Responsibilities include collecting rent, handling repairs, screening tenants, managing leases. Step 12, scale your portfolio. Once you've got one property under your belt, rinse and repeat. Use equity, cash flow, or refinancing to grow. Key real estate terms you should know. Real estate has its own language, and if you're new to investing, some of the terms can sound like alphabet soup. Let's break down the most important ones so you can talk the talk and walk the walk. 1. Appreciation. This refers to the increase in a property's value over time. It's one of the main ways investors build wealth, by holding on to properties that grow in value. 2. Cash flow. This is the money you pocket each month after all expenses are paid. Think rent income minus mortgage, taxes, insurance, and maintenance. Positive cash flow means your property is making you money. 3. Cap rate, capitalization rate, a metric used to evaluate the return on an investment property. It's calculated by dividing the net operating income by the property's purchase price. Higher cap rates usually mean higher risk and higher potential returns. 4. Equity. Equity is the portion of the property you truly own. If your house is worth $300,000 and you owe $200,000 on the mortgage, you have $100,000 in equity. 5. Leverage. This means using borrowed money, like a mortgage, to increase your potential return. Real estate is one of the few investment vehicles where leverage is commonly used and often encouraged. 6. ROI, return on investment. This measures how much profit you've made compared to what you invested. It's a key indicator of whether your investment is performing well. 7. Tenant screening, the process of evaluating potential renters. It includes checking credit scores, rental history, employment, and references to ensure you're getting reliable tenants. 8. Vacancy rate, the percentage of time your property is unoccupied. A high vacancy rate can hurt your cash flow, so keeping tenants in place is crucial. 9. Closing costs. These are the fees and expenses paid at the end of a real estate transaction. They include things like title insurance, attorney fees, and loan origination fees. Budget for 25% of the purchase price. 10. Title, the legal documentation that proves ownership of a property. When you buy real estate, you're transferring the title from the seller to yourself. 11. Escrow, a neutral third party holds funds or documents until all conditions of the sale are met. It's a way to protect both buyer and seller during the transaction. 12. Depreciation, a tax concept that lets you deduct the cost of a property over time. Even though your property may be appreciating in value, you can still claim depreciation to reduce your taxable income. 13.1031 Exchange, a strategy that allows you to sell one investment property and buy another without paying capital gains taxes, so long as you follow specific IRS rules. 14. Hard money loan, a short-term loan from a private lender, often used for fix and flip deals. These loans are fast but come with higher interest rates and fees. 15.MLS, multiple listing service, a database used by real estate agents to list and find properties. It's one of the most comprehensive tools for property searches. Common mistakes to avoid: skipping due diligence, always inspect and research. OM, underestimating costs, budget for repairs, vacancies, and surprises. Over-leveraging, don't borrow more than you can handle. Ignoring location, a great house in a bad area is still a bad investment. Poor tenant management, bad tenants can ruin your cash flow. Real-life success stories, let's look at a few examples. Story 1, the house hacker. Jane bought a duplex, lived in one unit, rented the other. Her rent covered the mortgage. She saved money, built equity, and eventually bought a second property. Story 2, the brrr master. Tunde bought a distressed property, renovated it, rented it out, refinanced, and used the cash to buy another. He repeated the process and built a portfolio of 10 properties in 5 years. Final thoughts? Your journey starts now. Real estate investing isn't just about buildings, it's about building your future. Whether you want financial freedom, generational wealth, or just a side hustle, the path is open. Start small, stay consistent, and keep learning. And hey, if you're turning this into a YouTube video, make sure to break it into digestible sections. Use visuals, real-life examples, and maybe even a few bloopers to keep it fun. Your audience will thank you.